Hey class, in this lecture we're going to be taking a look at Chapter 10, Accounting for Long-Term Liabilities. And the first learning objective we're going to take a look at is bond financing, and specifically how it's different than equity financing or stock financing. Now, what bond financing is going to be is similar to when a company would go to a bank and take out a loan with the bank. But instead of going to the bank, you go to stakeholders in the community. So this is similar to having shareholders owning stock in your company. Bondholders would be individuals that are putting up money similar to loan amounts uh, when aggregated together would comprise that public debt. And instead of calling it a loan, we call it a bond. That bond is going to have a face value associated with it, which is going to be the amount paid back at maturity, and is going to have something called coupon payments that are going to be made along the length of time that we have that loan outstanding for, that bond maturity value for. A long time ago, the bond certificate might have been issued, and on the face you would write the face amount. So that's why we call the amount paid back at maturity the face value. And then we'd also perhaps have coupons, kind of like something you turn into the grocery store or something along those lines, attached to the document itself. So that's why, and then you could take those coupons and return them to a financial institution to receive payment. So that's why we call the coupon payment that when it's being made, and the face value that when it's the amount paid back at maturity. Along the way, there's going to be interest amount. Now, the interest amount that's going to be paid is not necessarily going to be exactly the same thing as the coupon payment. And we'll take a look at that later in this lecture. But for now, you can think about that being part of the reason we might be paying those coupon payments is to service that interest. And then we're also going to have the proceeds that we receive once we issue the bond. And that amount's not necessarily going to be the same as the face value of the bond that we pay back, but you can think about it as being an approximation of it for right now. But we'll take a closer look as we go through this lecture. Now, what the advantages and disadvantages compared to equity financing would be is if we issue bonds and essentially issuing debt publicly, those bondholders are not going to have the same impact that stockholders would in terms of owner control. Stockholders are going to have voter rights that may involve putting individuals on our board that can control the CEO and CFO and direct what's going to happen within the company. Bondholders may have a better claim to assets on the amount that we have, what we have in terms of assets, but they don't have the same level of control. Their control is going to be limited to the contract that we set up for that bond itself. So we're able to retain some of that control for the shareholders as an advantage. Additionally, interest we pay on those bonds is going to be tax deductible, whereas the dividends we pay to our shareholders would not be. So there's a way to get money to our outside stakeholders, and that's going to overall save the company money, which is better for both shareholders and bondholders alike. And then it's listed here that bonds can increase return on equity, and they can do that in good times because you're introducing an element of risk with this leverage. So while things are going well in the economy and for our business, bondholders are going to receive those fixed payments no matter what, so they're not going to share in the increased profits that we're earning. The residuary claim that the shareholders have would, so that's going to increase the return on equity for the shareholders. Disadvantages is that we're going to require payment of both that interest and par value at maturity, so we're entering into an obligation. So we're going to have to pay that amount to the bondholders, whether it's good times or bad times. So if we're struggling, they're going to have the premier claim on our proceeds. So we're going to have to pay them first before the shareholders. So it's a disadvantage by putting them ahead of our shareholders in line. It's a disadvantage to our shareholders. It says bonds can decrease return on equity as well, and this gets back to that element of risk, to where if the economy turns sour and our business is doing poorly, here the residuary amounts that the shareholders receive is going to get reduced far faster because of those bond payments. So whereas we can, the risk will increase the shareholder return on equity in good times, it'll also decrease it in bad times. So let's take a look at the journal entries that we have for these bond issuances. And the first one is going to be at what we call par value. So all par value means is if we issued a bond with a face value of 100,000, that the amount we're able to receive is going to also be 100,000. This is also going to imply to where if we have our every 6 months payments or coupon payments set up to where the interest and the coupon rate that we have is going to match. So the amount we take in is going to equal the face value that we pay off at the end of the bond or at the end of the loan. And the amount we pay in coupon payments is going to correspond with the amount of interest that's going to be stated within that contract. So here, when we issue the bonds, we're going to receive 100,000 in cash, and then we're going to list our liability. Here, we're listed as a bonds payable, and it's going to be a long-term liability for us. And then over the span, we're going to have every 6 months or a semi-annual interest payment. For our coupon payment, we have an 8% stated rate for the year, annualized rate on this bond. So we're going to pay $8,000 per year, but we're paying it every 6 months. So every 6 months, we'll have a $4,000 coupon payment that's made. And we'll do that by taking a bond interest expense on our income statement of $4,000, which is going to be our debit. And then we're going to make payment in terms of cash for $4,000. So that would be our credit. And then once the bond matures, we will pay the face value. Here, again, the face value matching the proceeds would be $100,000. So we'll credit cash $100,000, and then we'll debit off the bonds payable of $100,000. Now, that example was at par value, in which the contract rate that we agreed to on the bond matched the market rate for interest. But we, as a bond issuer, can control that. We can set the contract rate at whatever we want to set it at. So if the 8% is the market rate for bonds, but we wanted to pay a 10% rate, we could offer that. Paying 10% when the going rate is 8% is going to be very attractive to a lot of investors, so we'll probably oversubscribe our issuance, and people will be willing to pay more than the $100,000 for that bond. Similarly, if we only wanted to pay 6% and the going rate was 8%, we could do that as well. We're going to have a hard time getting investors on board, so the amount we receive is probably going to be less than the $100,000. And we'll take a look at these examples to show, one, how that works from a finance perspective and how we get more proceeds at the front end or less proceeds at the front end, depending on whether we have a contract rate above or below market rate. And then, importantly for us, from an accounting standpoint, is how do you account for this amortization? So the first thing we're going to look at is computing and recording that amortization for the bond discount. And we use the straight line method. So the discount here, this is going to be to where the market interest rate is going to be 10%, and the stated interest rate is going to be 8%. So we've drafted our contract for an 8% rate, but what would be the going rate, if you want to think about it that way, or what the market should want to bear based on our risk profile, our credit risk, and inflation, and just what the economy should set our corporate debt at, should be 10%. So we are offering it for something below what the market anticipates seeing. So they're going to pay less for it. So we are have a face value associated with this of 100,000, but we're only going to garner we're only going to garner support from those external stakeholders of 96.4% of that value, so 96,400, and we're still going to make interest bond payments, coupon payments on every 6 months over the maturity of this bond. Let's take a look at what that looks like at the issuance. So we're still going to have that face value listed as our long-term liability because that's what we're going to be obligated to pay back at maturity. So we'll have a bonds payable credited of $100,000. We're only going to receive cash proceeds of $96,400. So we're going to have a debit listed on our journal entry here of a discount on bonds payable of $3,600. This is going to be a contra liability account, similar to what we saw with contra assets. Here we're going to have a contra liability. Now what we're going to do once the first interest payment is taken is we are going to have that same, again, if you remember, we had an 8% contract rate set up. So we're still going to have 100,000 times 8% would be 8,000 per year. We're paying every 6 months, so $4,000 is going to be what the coupon payment is going to be. So we'll credit cash by $4,000. Bond interest, however, is not going to be based on that 8% number, but rather on the 10% number. So the way we will calculate that interest is going to be to take the $16,000 in coupon payments and the $3,600 in the discount, add those two numbers together, and then divide it by the 4 payments we're going to make. So over the span of this time, we're going to have $4,900 of repayment is going to be what we have as debited as our bond interest expense. And this will take into account that 10% market rate. Now that difference between what we take as an interest expense of $4,900 and what we credit as cash for the actual money that we're paying is going to be listed as a credit to that discount on bonds payable. So the idea is over those 4 payments, we're going to have $900, and then $1,800, and then $2,700, and then $3,600. That's going to get total credited back. So we are going to credit back the entirety of that discount by the time we reach maturity. And you can see that listed here on our amortization, to where each payment we're going to have that discount that's going to kind of get chipped away at $900 at a time until the final maturity value gets paid of $100,000, and our carrying value, so the value of the debt itself, will increase from $96,400 or 96.4% of the face value will increase over time to that $100,000. So the bond will be worth $100,000 and paid $100,000 upon maturity. So now let's take a look at computing and recording the amortization for bond premium. So this is going to be where we're offering something better than what the market rate is on our contract terms. And again, we're using a straight line method. So the example here, market rate is still going to be 10%. Here we're offering 12% instead of 8%. Face value is still going to be $100,000, but we've got more interest in people willing to pay as investors in this debt more than the $100,000. So we're going to receive 103.6% of par value, or $103,600 at issuance, and we're still going to make our coupon payments on every 6 months. We're going to also calculate the interest expense for that every 6 months. Let's take a look at how we do that. The issuance itself, we're going to receive cash proceeds of $103,600. The bonds payable is still going to be $100,000. That's what we listed there. But we can list an additional liability as something we'll call here a premium on bonds payable of $3,600. So this is as if we had a $100,000 loan that was taken, and then because we received $103,600, we've kind of got an additional $3,600 loan that'll get paid along that span of time. We're listing them both as liabilities, but we're separating them as the bonds payable reflecting the face value and the premium on bonds payable reflecting the premium. So how that interest is going to get calculated here is similar to what we did with the discount. We're going to take the 12% contract rate that we have. We're going to have the 12% rate that we have here times the 100,000 is going to get us 12,000. We're making these payments every 6 months. So $6,000 per year is going to be the actual payments that we're going to have for coupon payments. And this is going to be based on that 12% contract rate. The market rate is only 10% though, so we're paying something above what that market rate is. So in order to calculate that and include the market rate into the interest expense, we're going to subtract our premium out. So we'll have the 24,000 representing all 4 payments of 6,000 minus the $3,600 premium to get 20,400. We'll divide 20,400 by 4 and get 5,100. So the amount of interest expense we take as our debit is going to be 5,100 for the 6-month point. The coupon payment, the cash payment, is still going to get credited at 6,000. That's what's physically being paid to the bond investor. And then the difference is going to be a debit to that premium on bonds. So similar to what we saw in the discount where we would credit off the 3,600. Here we have 3,600 listed as a liability, and we're going to have 4 payments of 900 that's going to get debited to where that liability is going to get reduced to 0 over time prior to the return of the face value at maturity. So we would have 900, 1,800, 2,700, 3,600, and then only 100,000 left upon payment of the face value. So looking at that amortization table, you can see the amount go from 3,600 to 0 on the left-hand part of the table labeled unamortized premium. And the carrying value here is going to reduce from 103,600 to converge on 100,000 when that maturity payment is made. So once we do make that $100,000 payment to retire our bonds, we can do that in a conventional way, which is just making a cash payment at the time of maturity. So here we would debit off 100,000 of the bonds payable and credit 100,000 in cash to make that payment. We might have something called a covenant, basically just a term within that bond that allows us to recall those bonds and retire them early. And in that case, because bonds are going to be securitized and traded the same way stocks are, they might be trading above valuation or below valuation, and we might have a gain or a loss that gets recognized. In the example that we've listed here, we're going to have the gain of 1,500 that's going to get listed if we retire early because the carrying value is going to be greater than that retirement price. So we would still debit off the 100,000 for the bonds payable by retiring it early, and then we'd have a premium on the bonds payable of 4,500 that would get debited off. So we're going to remove that. The amount that we're going to have for cash payment here is just going to be 103,000. So if you think about it, we're paying $103,000 in cash for something worth 104,500, and then so we're realizing a $1,500 gain here. So we'll see that as a credit, similar to the way we would have revenue being a credit on our journal entry. So that gain for the bond retirement is going to get listed as a $1,500 credit here. Had it been a loss, we would see that as a debit. The other way we might retire those is going to be a conversion. So again, we might have a covenant or a term in our contract that says that we can take those bonds and make them into stocks if a certain rate is triggered. Had we done that and we were going to convert $100,000 in bonds to $100,000 in cash, we would debit off the $100,000 in bonds, and then here we've got something that we'll learn a little bit in next week's lecture for Chapter 11 in terms of how equity financing works and kind of what the par valuations are going to be. But for now, let's just think about the 100,000 as being a credit to common stock. And we've got some things we'll go into more detail next week in terms of the way it gets listed. But that common stock is going to get broken out into 2 terms. One is just going to be called common stock or par value. And the other is going to be paid-in capital, and it's going to be in excess of par value. And the only thing that's going to mean is going to be that we're going to have 30,000 that's common stock that's considered within par value, and then 70,000 that's going to be attributed to the common stock that's above that par value amount. So it's just a way of keeping equity financing separate. For ours, if we had a stock that did not have any par value, it would be just the same to see the journal entry labeled bond payable, a debit of 100,000, common stock, a credit of 100,000. So for now, we can kind of put aside why the 30,000 and 70,000 is, but we'll take a deeper dive into that for the next lecture. And then for our notes payable that we have, so note payable just being a contract agreement that we have with a counterparty, similar to what we had for the bond payable. We're going to have a few different ways that we can arrange these contracts, similar to how we can arrange the bonds, quite frankly. We're going to be paying cash from the company to lender. In this case, here we're going to be the ones making the loan, but the contract is going to be terms are going to be similar. So we going to want to know the note date. We're going to know the note maturity date. So one way we could set it up is going to be for the lender to borrow the money and then pay us back all of the amount upon maturity. And then for the bonds payable example, this would be if we were to have no coupon payments along the way and have a zero coupon bond, we might pay all of the principal payment and all of the interest on that maturity date. So here our lender is going to be making a single payment as well as the principal plus interest on the maturity for the proceeds borrowed. Another way we could do it is to have no face value, but to pay back a portion of that principal over time. And this is similar to the way a mortgage might get paid back, to where you're going to borrow a lot up front and make regular payments, and then once you make your last regular payment, you have paid all the principal and all the interest back. We can do that kind of structure as well, to where if we set up a contract where we're going to make regular payments, principal and interest to lender, then we would set up what those payments would be and amortize them across the time. So it would look more like paying off the premium that we had on our bond payable, as opposed to paying the big lump sum face value. So this is going to come into place from a company standpoint. Again, if we are entering into a contract to where we are going to be the borrower of funds, this kind of outlines how we're going to be able to structure that note payable. And in that case, it would be a liability for us, and we'd be making payments to a counterparty that we've borrowed monies from. And once we make that note payable, set it as our liability, we'd also have a debit as our the amount of cash that we borrowed. Similarly, we may have a situation where the CEO or the CFO or someone within the company asks the company for a loan. And if we agree to make this loan to that individual, we would see the note listed as a note receivable as an asset, and then we'd credit off cash once we made the loan. And then these same terms can illustrate how that individual could be paying us back as the company. And then once we are setting up our debt and equity financing, one thing that financial analysts will look at is, well, what's the ratio? How much debt do you have to how much equity? And a conventional way to take a look at this is just going to be something called a debt to equity ratio, in which we're going to take our total liabilities and then the total amount of equity and figure out what that ratio is. You can see below in the exhibit, we're going to have two companies, Nike and Under Armour, and then setting out what their current 1 year ago, 2 years ago total liabilities are, total equity are, and then making that calculation of dividing total liabilities by total equity to get the debt to equity ratio. And then what we're going to see here is debt to equity ratio for Nike is increasing from 70%, or 0.70 rather, to 0.87. So taking on more liability per dollar of equity that they have. And then the same thing's happening with Under Armour. So 0.72 to 0.98. So both of these companies over that 2-year span are taking on a little bit more leverage, which is going to be a measure kind of suggesting that these companies are taking on a little bit more risk over time. And that's going to be one of the factors that as a financial analyst that you are considering in terms of valuing what that company is going to be worth. And this is going to conclude our lecture on Chapter 10.